Well, good morning, everyone. Thank you for joining the Market Update webinar with GrainFox today. On behalf of Syngenta, we appreciate your time this morning and joining us. My name is Kevin Kurlick. I'm a territory sales representative out of Grand Prairie in Northern Alberta, and I'll be hosting the webinar today. So a little bit about me. I've been with Syngenta just over 20 years. Been in the same territory up in Northern Alberta during that entire time. So I've met a lot of people across Western Canada throughout the years and a lot of our customers. So thank you for joining us. I always think of the grain markets a little bit like a sports team because I'm a big sports guy. So I always think about the grain markets like my beloved Edmonton Oilers. There's always extreme optimism in the markets, but sometimes you don't get the wins that you expect. So today we'll get some more information from the experts on the markets, and hopefully we can capture some of those upsides. So just a few things. It'll be about approximately an hour and a half webinar, about an hour of presentation, somewhere in that range. And then we will go into some Q&A so that everybody has a chance to get their specific questions answered. There will be continuing education unit credits available. There will be a QR code at the end. So those of you that have CCA, you can apply for those at the end of the session, and there will be a QR code for that. Like I said, any technical assistance during the webinar, always call the 187 Syngenta number. It's appearing on the slide right now, so that will allow you to talk to somebody in person, and they can get you sorted out so you can get on the webinar or whatever you need. To ask questions, please use the Q&A button. They will be answered at the end of the presentation, and we'll be monitoring that the whole presentation. And we will be continuing to keep the questions flowing. There will be a post-event survey. It'll be approximately a 3-minute survey, so just look for that after the event wraps up today. One note is this webinar is being recorded, so your participation is deemed to be consent. So please don't use your phones or anything else to record the webinar. You will get a copy of it at the end. Once we've edited it out and made sure that all the it's cleaned up and made sure it's all presentable, we will send it out, so you will get a full presentation. Okay, with that, I'd like to introduce our two speakers today. So Neil Townsend, he's got more than 2 decades of market analysis and advisory expertise. Neil spearheads GrainFox and FarmLink's analysis, leveraging his profound understanding of agricultural commodity shifts, market acumen, and his distinctive touch of dry humor. Through unwavering research efforts, Neil and his team formulate comprehensive market projections encompassing trends, supply-demand dynamics, and price prospects. This culminates in well-timed and enlightened sales recommendations, providing actionable insights for informed decision-making. Neil's partner today is Ranulph Glanville. He's the Chief Market Analyst at DePutter Publishing, GrainFox and DePutter Publishing. So in 2022, Ranulph became a part of the GrainFox team. That was following a notable 19-year tenure at DePutter Publishing. During his time there, Ranulph, he served as the Vice President and had a senior role as a commodity market analyst. So some of you have been around, you've listened to both gentlemen. And in an instrumental figure, Ranulph contributes significantly to furnishing farm market insights and counsel across numerous GrainFox and DePutter publications. With academic accomplishments spanning a BSc in engineering and MBA from the Richard Ivey School of Business, and the distinction of being a chartered financial analyst, Ranulph brings a wealth of expertise to his current role. So without further ado, I'm going to turn it over to Neil and Ranulph, and you guys are in good hands today, and enjoy the market update.
Yeah, thank you very much for those kind words, Kevin. On behalf of Neil, I want to say that we are thrilled to be here, and we hope to provide a fast-moving and insightful event for you today. And we're looking forward very much to the question and answer at the end. So this is a general market update. We do want to start with a bit of a macro overview. If you've been attending these webinars, even back in the John DePutter days, the DePutter Publishing days, You know that John liked to start out with the macro overview, and Neil and I like to do the same. From there, we'll be moving to a fast-moving segment that we call toss-up. Neil will be introducing that in a few moments. We're going to be looking at the grains, mainly wheat, durum, barley, and oats, and then moving on to the oil seeds, specifically canola and soybeans. We're also going to have some comments on the pulse and special crops, and then we'll dive into that Q&A at the end. So, macro overview. Well, let's talk a little bit about the US election, interest rates, crude oil, fuel, weather, and more. There's a saying, apparently, in Chinese that may you live in interesting times. And this is sometimes thought of as a blessing, and it's sometimes thought of as a curse. But there is no question, however you interpret it, we do, in fact, live in very interesting times, starting, of course, with the US. US politics are set to become front and center in the commodity markets in 2025, whether we like it or not. So we've come through the US election in November, and what did we get out of that? Well, the American people have spoken. President-elect Trump is back, and he has a very clear mandate. He has control of both the House, the Senate, and he won the popular vote. So, say what you will, he has an agenda to carry out, and he's been given a mandate to do it. What about Ukraine? Well, this is an interesting one because on the campaign trail, President Trump repeatedly said he would end the war in Ukraine. Full stop, end of story. Now, we'll see what actually happens in reality, but probably the chance of a negotiated settlement to the war in Ukraine, the terrible war, and nobody wants it to continue. A negotiated settlement looks more than possible in 2025. We'll have to see how things play out. What will trade policies look like under Trump 2.0? Well, this is the million-dollar question, if not the billion-dollar question, and it's on a lot of your minds these days, as it is on my mind and Neil's mind. President Trump has talked about the reopening of the trade deal, which, ironically enough, he helped negotiate during his first term with Canada and Mexico. But surprise, surprise, he doesn't like the deal. That's what he's saying. He wants to reopen it. That's the threat. And there is a clause in the deal that allows it to be reopened in 2026 anyways. So that'll be something we're watching closely. Meanwhile, of course, this week we got the news, 25% blanket tariffs on all goods from Canada, Mexico, an extra 10% on China, which already faces some tariffs into the US. Is this a negotiating tactic before he takes office? Is this a legitimate threat that he intends to carry out? We don't know yet. So far, he's only made the proclamations on social media, which is not the US government in terms of enacting law. So there's a lot of moving parts here, and this is very much on the minds of market participants. We have seen some of the markets take his threats seriously. We saw a drop in the Canadian dollar, for example, shortly after his pronouncement came out. But other markets, like the stock market, seem much more sanguine and sort of taking a wait and see approach, not really convinced that he's actually going to follow through on this. We have seen the US dollar be a big winner out of all of this. Cryptocurrencies, another huge winner under Trump. And of course, those offshore betting sites. Now, if you don't know what I'm talking about here, President Trump was predicted to win on some of these offshore betting sites before the election. People said, nah, that'll never happen. It's a couple big bets skewing things. But on this case, they did seem to get it right. Russia, of course, is another huge story. The slow, terrible, grinding war in Ukraine is a direct result of Russia's aggression. And of course, it's taking a toll on Russia in terms of its trade relationships with the rest of the world. I don't feel sorry for them, of course, but there's no disputing it is affecting grain flows. And so any change in the status of the war could redirect grain flows and oilseed flows. Of course, there's increasing rhetoric right now out of Europe Russia is still central to the European energy supply, so Europe is in a very delicate balancing act here. We do know that grain supplies within Russia are being drawn down, and Putin and his cronies are taking control of the export infrastructure, trying to slow the flow of grain, trying to implement an export floor on wheat prices. It does remain to be seen if that will take hold, if it will actually stick, but that's the plan today. We've heard of some switching of crops in Russia as a result of all these policies. And we have, of course, found out since 2022, when Russia attacked Ukraine, that Russia still has friends. They may not be Canada or the United States, but Russia has found trading partners, whether it's China, India, or countries elsewhere. And so what we've seen is a redistribution of Russia's commodity exports, not a halt, as some people initially thought back in 2022 when prices spiked. Interest rates are an interesting topic. Farmers don't grow interest rates, but for most, it has a huge impact on your bottom line because as a group, farmers are heavily indebted. If you're not, that's fantastic, but many of your peers are. And we did see a spike in interest rates in 2021 and 2022. Now we are on the downslope. The good news, if you're hoping for lower interest rates, there's no sign we're at the bottom yet. Both inflation and interest rates are trending lower. This is a double-edged sword, of course, for savers, people hoping for higher interest rates and who actually enjoyed the bump in interest rates on GICs and other savings vehicles in 2021 and 22. Now they seem to be facing tougher times. But for now, it does appear that interest rates are headed lower, and specifically in Canada, the threat of trade tariffs, weakness in crude oil, other factors suggest we are not at the bottom yet. Speaking of crude oil, this is a market which has been extremely volatile and yet has accomplished very little in the grand scheme of things over the past 18 months. If you look at the chart, you see that very briefly in 2020, at the start of the COVID crisis, crude oil actually went negative. Now, you weren't getting free diesel at the pump, but that was a figment of what was happening in the traders markets down in New York, and the fact that barrels down in Oklahoma were simply full of crude oil. There was nowhere else to put it. Since then, we saw a big comeback culminating in 2022 when, surprise, surprise, Russia attacked Ukraine, causing crude oil to spike along with most of the grains and oilseeds and other commodities. More recently, this past 18 months I was referring to, crude oil has been in a trading range between roughly $65 and $90. Right now, it's in the bottom of that range, and it is absorbing these news items that we hear from President Trump and others. You know, drill, baby, drill is the mantra. The US, according to the government, wants cheap energy and seems intent on driving prices down by drilling more. We'll have to wait and see if they succeed. Quite frankly, there have been some skeptics, myself included, that they can actually magically increase production in a short turnaround. Make no mistake, though, what happens with crude is very important. It affects your prices, gasoline and diesel, but it also affects things like commodities in general. Crude oil is a bellwether commodity. As goes crude oil, so go most commodities. Crude oil is also a leading indicator for the energy side of things like the oilseeds and the grains. So this is one to watch closely. For now, crude is at the bottom of a trading range, but still in a trading range. Speaking of fuel costs, excuse me, you don't need me to tell you that fuel costs remain stubbornly high. They've come down, but generally are still way above where they were in the 2014 to 2020 timeframe. So the question, of course, becomes what's ahead. And quite frankly, with crude oil in a choppy trading range, we don't have a clear signal for what's ahead for fuel prices. The weak Canadian dollar actually supports our fuel prices relative to US prices. So that is the flip side. You might say weak Canadian dollar is good for the canola basis or the wheat basis, but it's not particularly helpful at the pump. It actually supports prices for your inputs. We do know that with many crop prices having come down from the highs, farmers are increasingly susceptible to changes in input costs. Quite frankly, it just affects the bottom line. So for now, diesel and other fuel prices remain stubbornly high. Fertilizer is also influenced to some degree by what's happening in the energy markets. And fertilizer prices as a group exploded higher in the 2021 and 22 timeframe, and then they collapsed. And more recently, we've seen pockets of stability in global fertilizer markets. I'm not saying necessarily at your dealer, but in general, some stability has crept in. And as we move into the winter, of course, we know you start to look ahead to the spring planting season, the spring application season. You start to wonder, I start to wonder, how much more downside will there be? Now, before I go any further, I want to make it clear, I am not a fertilizer expert. GrainFox is not focused on fertilizer. Neil and I like to just watch it because it is another very important input cost, and we fully respect that for this group, fertilizer is important. My 10,000-foot view would be that if you see fertilizer prices that make sense to you to lock in a small way based on your understanding of your operation, I certainly wouldn't disagree. Prices have come way down, and we do have the spring planting not too far on the horizon. At a macro level, a big picture level, I would also say that bull markets have consequences. The run-up that we saw in fertilizer in 2022 will have a flip side. Demand will be rationed, supplies will increase, new supply will come online, and it won't happen overnight, but it has already started to happen if you just look at what's happening with prices. So I don't think we're going to flip to a new bull market in fertilizer right away. That is just a general comment to do with as you see fit, as you make your decisions for your operation. So what about the weather? Well, the weather is another thing. Everybody talks about it. Nobody does anything about it, as the saying goes. But we do know right now, South America is really one of the most important weather regions in the world. Today, we have good conditions for crops in Brazil, good conditions for crops in Argentina. It's early. These crops aren't fully made yet, but they're off to a very strong start. Think Canadian crops in May, in early June. These crops are really looking good. As a farmer, you know the crop isn't made till it's made. It's never safely in the bin till it's safely in the bin or out of the field and on its way to market. But for now, we see nothing in the latest weather forecast from South America to tell us there's going to be a problem. So we need to keep that in mind. Of course, some of this, if not most of it, is already in the prices. This is one reason soybeans collapsed in November. This is one reason canola fell in sympathy with soybeans. Corn is down, wheat is down. Why? There is no weather threat in South America. Will that change in December and January? That's a critical point. But for now, the weather is not doing prices any favors. So let's move on. I'm going to bring Neil in here. We're going to jump into a segment called Toss Up.
Well, thanks a lot, Ranulph, and thanks to everybody attending the webinar, and of course, Syngenta. I'm happy to be here. Just want to introduce the concept of toss-up. I'm going to give Ranulph a choice, and then Ranulph will give me a choice. It's a binary choice. We have to hold our feet to the fire and make a choice, as difficult as it might be. We could have called it Sophie's choice, but we'll just call it toss-up. We're going to cover a wide range of topics, hopefully in an entertaining and fast-moving way. So here we go, Ranulph. Would you rather know the next big move by crude oil or where canola ending stocks will come in for 2024-25?
Yeah, interesting question. Obviously, both are important. I think given the audience that we're speaking to here today, I'd rather know what's going to happen with canola ending stocks because there does seem to be a bit of a disconnect developing with canola. Supplies don't seem as heavy as we thought before harvest. Demand has gotten off to an excellent start with crush and exports both moving pretty well. So I'm really, really curious how that's going to turn out. And I think to this audience, that's probably going to be of much greater interest than crude oil, which is, as I mentioned, sort of a bellwether commodity, but not something that we're growing or producing directly. So here's the first one for you, Neil. Would you rather know where the Canadian dollar will be in a year or how aggressively China will stimulate its economy in the year ahead?
Yeah, I mean, in a way, it's two sides of the same coin because we're entering into such a disruptive and uncertain time based on the US election results and the promise of Trump to impose, tariffs across the board and relatively large tariffs against Canada and Mexico on the first day that he's in office. And obviously, we've seen how the Canadian dollar reacted to that, and it was pretty negative. But overall, and from a Canadian perspective, as important as the Canadian dollar is, and you could say it's huge, I think from our exporting position, the Chinese economy is actually the one that's more important. And if it's going to remain moribund and hard to kickstart and stagnant, I think that's more of a threat to the world economy in many ways than some of the policy changes that we're going to maybe see. I mean, we thought we were going to live in an era where China is going to mop up all of the excess that we produce, be it yellow peas or wheat or canola in particular, malt barley. But now it looks like China is sort of an aging population, not doing too well, lots of unemployment, lots of under, you know, like they're not liquid. They've got property problems. So we thought they would kickstart their economy coming out of the pandemic. That has not happened. And I think, we're sort of shielded a bit because we're beside the behemoth, the unambiguous winner in the world economy right now is the US, even if a lot of the US population doesn't feel that way. In a relative sense, they're number one and they've stayed number one. And in a relative sense, China's number two, but they seem to be a fading number two. Like the gap between them and the US isn't as small as we probably thought it would be at this time. So yeah, I'm much more inclined towards finding out about China just because if China's not going to be there to mop up our surplus, then Canada better go out and develop some new markets quickly. And with the uncertainty coming from the US, it might not be biofuel, it might not be renewable diesel, it might have to be something else. So we'll see. So turning back to you, Ranulph, which is more important, Indian rabi crop production this year or US acreage plans for 2025?
Yeah, good question. I think the answer partly depends on what segment of agriculture are you in. If you're in peas and lentils, pulses, you're probably very interested in what's happening with India. Rabi crops there are off to a very strong start. This is their most important producing season for many of the crops that we talk about here in Canada. But the interesting thing is that despite all the intrigue around India, I'm going to pick the US acreage plans for 2025 because, as you say, they are our neighbor. They have a direct and immediate impact on Canadian prices for grains, for oilseeds, and for many of the other crops and commodities that we produce. So what am I thinking about US acreage for 2025? It's early, let's be clear, but I agree with the analysts who are lining up under the idea that corn acres will probably be higher by 1 to 3 million. 3 would probably be pretty aggressive, but 1 or 2. And soybeans will likely be down by a similar amount. So I think as we move into the spring and winter, that'll become increasingly important as a big factor driving futures markets, particularly on the new crop side. You're going to see a lot of sensitivity to that in January and February. So here's a question for you, Neil. Are you more interested in Canadian acreage shifts, particularly things like canola and spring wheat, Or are you interested in what Russia has in store for its grain export policies in the year ahead?
Not even close. I'm much more interested in the latter. I mean, I think that the Canadian farmer is looking at this situation. He's looking at all of the uncertainty. And I mean, I would hope and think that he's going to stick to rotation and there's not going to be any big swings in acreage in the, for the most part. But Russia is a key factor in the world wheat market. It has an influence in some of the other markets too. It's a growing competitor in things like yellow peas and stuff like that. Grows some canola, grows some corn, grows some other things. But on the wheat side, their export policies are very important. Now, they've had a poor crop this past year. Things don't look great for their winter wheat, although the weather has improved a little bit here, but there's a question mark around how much acreage there are. In the meantime, the Russian economy is really doing poorly. The ruble has tanked. If you think about the US election and you boil it down to like the most simple statement possible, you'd say, well, the price of eggs was too high, so people voted to get rid of the government. Well, the price of everything in Russia right now is getting more expensive for the population because the ruble is losing value. And there's going to be rampant inflation and people aren't going to be happy. And you tie that in with a short wheat crop. Russia, they consume way more flour per capita than we do in Canada. It's almost double. Bread is a critically important food in Russia in terms of, food security. And let's just say this, I've been to Russia several times. Most of Russia doesn't look anything like Moscow. I've been out in the hinterland. I've been to, flour mills. I've been to, grain elevators. And one thing I noticed at a grain elevator, not even a flour mill, they had a huge bakery in the grain elevator. And I was like, what is this? And they said, well, actually, this is like local food security. We bake the bread, we take it to the schools, the kids get to take it home to their families. So, this was in 2009. So we're not talking about, 40, 50 years ago. This is still ongoing, and Russia hasn't gotten any richer since then. So their export policy is going to be really, really important. And I think sometime in 2024, 25, we're going to see significant restrictions on exports for wheat. And I think that will have a positive impact on the wheat market. Now, a negative impact on the wheat market might be that I do suspect we're going to see some actual negotiations for a settlement of the war in Ukraine. And we may even see a pause in the fighting, and we'll see if that has a little bit of a deflationary impact on the wheat market, just because, we thought there was a war premium, and then you have to take out the war premium. So another one for you, Ranulph. Ranulph, would you rather know where Canadian land prices will end up in 2025 or how significantly interest rates are going to be cut?
I'll go with interest rate cuts, and here's why. I think although almost everyone on this call would love to know where land prices are going to end 2025, I don't think there's too many people, myself included, who think they're going to be lower than they are today. It seems like land prices in Canada, specifically for good agricultural land, have been on a one-way journey higher over the past 30 years. It defies me sometimes how prices are where they are. Can people turn a profit on land priced at this with crop prices over here? I don't know the answer to that, but I don't think there's much likelihood land prices are going to come down, much if at all, in the year ahead. Interest rates, however, are trending lower. They are an important factor in everything from activity in the Canadian housing market to land prices themselves. So I'm very interested in watching that closely. As I mentioned earlier, there's no question today the trajectory for interest rates in Canada is down. The only thing I would say as we move into 2025, watch inflation, because if inflation starts to make a comeback, that's when I think you could start to watch for signs of a low forming for interest rates. Here's a final one for you, Neil. So a bit of a drum roll. Would you rather know where South American crop production will end up or trade policies under the new US administration?
Now, I'm a fundamentalist when it comes to doing grain and oilseed analysis, pulses as well. I like to count, supply, and I like to project demand. I will say, and I've talked to, lots of people, including Ranulph, many analysts that you know across Western Canada and around the world. And when we sort of huddle up and we console each other about how difficult our job is, the one consensus we say is that this job has gotten incredibly less fun over the last 15 years and much harder over the last 15 years. And it's because we have to deal with things like politics, macroeconomics, pandemics. All of these things are not just counting up supply and demand. And when we look at the world, I would love to say that I just want to figure out what the South American crop is, and that's going to tell me what the prices are going to be for the rest of this marketing year and into 25, 26, because the South American crop has such a long tail. Unfortunately, I think it's important. I think it's going to be relatively bearish as it stands today. Ranulph showed you some slides. But I'm also the guy who was kind of caught a little bit surprised because Ranulph mentioned those betting sites offshore. And I remember commenting on one of those in one of our podcasts and just saying, well, I can see Trump winning the electoral college, but I don't think Trump will win the popular vote. But he won the popular vote, not by a huge percentage, but that's the first time he won the popular vote. And mandate. And one of his mandates is US isolationism, US exceptionalism, and it's, make America great again. And even though all of the economists and everybody is telling them that, tariffs are not really something that punishes the other people, you pay for them internally, they're bound and determined to go forward to them. And I don't know, is it negotiating tactics? Are they going to keep them on for a long period of time? I mean, what other kind of trade issues are going to come up? I mean, if I were in a cave and you took me out in 6 months and started telling me what happened, I always call this like the caveman principle. Like, I don't think you could tell me something that would surprise me because I'd be like, yeah, I guess that could happen. And that's the thing. It makes our job very, very hard. And unfortunately, trade policies are going to be something that we are going to be discussing and talking about for a long period of time. And my final point is one of the differences between, say, an Australian or Canadian farmer and his American counterpart is we have made it a policy here to let the market determine the success or failure of farming. In the US, even though they're our best friends, they're also, in a way, our worst enemies when it comes to farming because they have risk-free farming. They have insurance programs that are top-notch, creme de la creme. They also have a government, especially with Trump and the way the Senate's allocated and the electoral colleges, that if they do pay a price because of the tariff policies, they're just going to write them a big check and keep them in business and keep them producing. So I don't expect any acres to go out of fashion. And then when you look at the Brazilian farmer, his currency is getting wrecked. So his incentive is to sell and to grow and to plant and to do more. So it's going to be potentially a very tough situation. And on that note, let's move into the grains and try and find a silver lining. So, I used to say that my favorite variable was what was the U.S. corn yield, or what happened to the magnitude and direction of U.S. corn stocks year on year. It's still an important thing, but in the course of my lifetime, in the course of your lifetime in agriculture, we've seen the growth of South America from a relatively small participant in corn and soybeans to mammoth participants, particularly in soybeans, but also in corn. So the US just pulled off a record yield for corn. The corn sort of the corn dynamics, the corn technology doesn't show any signs of slipping. It looks like at some point in the next 10 years, we're going to be talking about a 200 or a 205 bushel an acre yield. There's a lot of growth to happen, and that corn yield that the U.S. is sort of maximizing right now also gets exported to around the world. So for this year, the U.S. was successful, but the threat is that the techniques, the seed technology, that will be further exported around the world, and we'll see more and more corn capacity. Now, they had a slightly smaller acreage this year, so production was down slightly, but still relatively big. What I like to do is I like to see how are the stocks changing, and that's the most important variable is the relativity of stocks. Are they, and it's magnitude and direction. Magnitude is big, little. Is it a big change? Is it a little change? Direction is up or down. And I do these matrices and I make them simple because I'm a simple person. And so green means comfortable and relatively bearish. Yellow means, oh, I'm starting to get interested. And red means very exciting. And you can see on this chart, there's no red here. The green is good. If we were to lose 200 million bushels of demand, you'd see we'd just be more in the green. We'd move sort of to the right and low, right. But if we gain 200 million bushels of demand, higher exports, more ethanol usage, etc., we would get sort of in that cusp of, something that's somewhat supportive for corn. It's interesting. One of our friends down in the United States, he ran a little survey with commercials, and he asked the commercial companies that he deals with, are you bullish or bearish corn? And roughly 50% said they're quite bullish and 50% said they're quite bearish. Yet when he looked at the regression analysis to see where the stocks to use to price was, he said that actually the price was right where it should be. And in other words, he thought both sides are going to be wrong and corn prices are not going to change that much. And in a way, that's what this chart says here. It says that we are expanding the comfort level of stocks in the United States, not dramatically year on year. We're a fair distance away from where we need to get excited, which is about the 30 days of use at the end of August or at the end of September. Sorry, at the end of August, correct? And so, we need to lose probably upwards of about 700 million bushels of stocks. That's a very difficult task this late with this big of a South American crop coming. But by the same token, because they've already committed to large amounts of exports, it would be difficult for us to grow it too much. The big X factor in the corn supply and demand balance, or the US supply and demand balance, is they're picking on one of their best markets, which is Mexico. They're exporting a massive quantity of corn to Mexico, and they export, proteins as well down there. So, I mean, if they sort of bite the hand that feeds them in terms of, sucking up some of their surplus, there could be an expansion. But again, I would put the cap at sort of 1 to 200 million bushels. That would be relatively bearish, but I don't think we'd see a dramatic change in the price. And we always start with corn because corn is king. I mean, a lot of you maybe don't grow any corn, but trust me, the corn price is dictating somewhat the prices of everything else that we do deal with in Canada. So the USDA, they didn't do any big changes for November with what they see coming in South America. Really, as Randolph mentioned, the weather has improved there quite dramatically, but the key weather, the weather that's going to move the market, is going to be in January, February, March, and to a lesser extent, early part of April. And they're going to have at least one in one major region down there, too hot, too cold, too wet, too dry event. And we're going to see a little bit of a bounce. The question is, will it be widespread enough to become a reality, or will it just be localized and it will just be a temporary thing? And again, remember, the politics is going to have a big influence on what's happening in South America as well. They have sort of Argentina, where the weather looks good, but again, the economy in Argentina is in the toilet. Their president has sort of made more people poor, not more people rich. And again, the farmers are a particular type of person in Argentina. They're not out in the soil. They're wearing white shirts and they're sitting at desks in Buenos Aires. So they could also have an influence on how they export the crop, and there could be more taxes, more export restrictions. So there's a lot unknown about South America, but right now the crop does look big, and we expect to see the USDA, maybe not in December, but in January and February, they could adjust those numbers upwards depending on the weather patterns. I don't pay too much attention to world corn stocks because, half or 2/3 of them are allegedly in China. I don't think China has stocks anywhere close to that. But I mean, again, there's no story in world stocks right now. They're comfortable. They're not growing excessively year on year. if they were growing by 30 or 40 million tons, it would be likely be because of, a large US growth in stocks or South America. The Chinese stocks kind of stay flat or grow whatever the Chinese government decides to print. But, it's a little bit of a nonsense in my opinion. So corn has had, not much of a recovery post-harvest. It's gotten a little bit of support, shall we say, from very strong US export sales. They've continued to be relatively robust. There was, a 5 to 6 week period where they were quite exciting. But just sort of the political uncertainty, and I think the real concern about the soybean balance sheet has been a bit of a drag on corn. So again, global stocks of wheat, you really have to sort of separate out China, the world, because if you're just looking at global wheat stocks, they're very large, but again, I think 60 or 70% of that is theoretically in China. Again, it does not really exist, I don't think, to that extent. So, there's not much here. So what I like to do is I like to look at two sets of wheat stocks, and one set is contained within the other set. So it's the big 8 wheat exporting stocks. So that would be Argentina, Australia, Canada, the European Union, the US, and then the so-called RUC, Russia, Ukraine, Kazakhstan. And you can see, just generally speaking, the big 8 wheat ending stocks, and typically these countries account for about 85 to 90% of global wheat exports. You can see they're kind of getting a little bit tighter, and the countries that are getting the most tight are sort of Russia, Ukraine, and Kazakhstan. And, Kazakhstan's maybe a little bit sloppier than the others, but we've seen significant reductions in the amount of surplus that Russia and Ukraine have. And those are the aggressive exporters. Kazakhstan is a local exporter. Some of it can come out into the world, but really they're handling all the other stands like, Kyrgyzstan, Turkmenistan, Tajikistan, a lot of stands. I can't even name them all, but there's a lot of them, trust me. And the Russian crop continues to sort of get smaller. This is one place where the USDA and Russian analysts are aligned. The last couple of years, they have not been aligned. The Russian analysts have claimed a much larger crop than the USDA has put it. So that could also play into what their stockpile is. But their behavior so far looks like their stocks are tightening, but around about an 82, 81 million ton crop for last year. And question marks remain about the final total, but question marks also remain about, how successful was the winter wheat planting in South Russia? And we've heard actual comments from a lot of Russians and some intelligence sources that I have that, some acres did not get planted because, the only acre without potential is the acre that doesn't get planted. I'm not somebody who obsesses about winter wheat conditions prior to going into dormancy. The crops can make a big rebound when they come out of dormancy, but in this case, there is some speculation because of excessive dryness that some acres did not get planted in Russia, and that total could be as high as 10 to 15% of intended acres. That would be relatively supportive. Again, we'll wait to see what happens and try to get some clarification there. We did see a little bit of a rebound in Australia, and also Argentina had a bigger crop. The Australian crop is being harvested as we speak. Australian prices have been relatively stable through the harvest period. The one thing we know is that if the Australian crop, say, the speculation is around about 32 million tons. If it ends up at 35 million tons, and that's possible, we've heard maybe slightly better results than expected from West Australia. And remember, West Australia and the eastern part of Australia operate really as two distinct countries. There's no trade between the two of them. Wheat does not move from West Australia over to East Australia. If they grow more wheat in West Australia, or in East Australia for that fact, it gets exported. So if they end up with 35 million, there's going to be 3 million extra incremental wheat million tons that are out there in the market, and that's going to be detrimental to Canadian prospects for the second part of the year. How detrimental? I don't think it will be too detrimental because what the world has shown is that they have a very strong need for Canadian wheat, particularly our CWRS. It's an excellent blending wheat, and it's obviously it's the premier wheat for making high quality breads and high quality baked products. But and for blending, because there's been a lot of sort of mid-grade type wheats produced in a lot of countries, like France had excessive rain, so any wheat that they could manage to export isn't going to be necessarily like clean. So throwing a bit more Canadian wheat to bring that up to baking standards or milling standards, that kind of thing. Argentina, I'm not too concerned about their crop. Most of their crop will get exported, or their exportable surplus into Mercosur and go to Brazil. So here's our initial thoughts on 2025 acreage. It's early. I don't think farmers have a good grasp on what the economics will look like for 2025. There's a lot of uncertainty because we don't know what the parameters around world trade will look like for 2025. So, I mean, my advice to a farmer who asked would be probably stick to rotation. That's been your best strategy, risk management strategy over the last 15, 20 years, and let it continue to be your best risk management strategy going forward. But we do see a little bit more spring wheat. We think that, one thing I would say is that there is some value to crops that can be transacted 365 days a year. And agronomically, wheat hasn't had a lot of problems lately in terms of disease. Again, I'm not talking about any specific farmer. I'm talking about generalities, whereas we have seen some agronomic challenges in some of the other crops, like even canola and some of the pulses. So, you'll have a chance to look at this. People ask quite a bit about, like, because people feel very nervous, like, should I price some 2025 crop right now? And again, we don't have any big thoughts on prices in 2025. Our main comment, if something does pencil out black and you have a significant and serious approach to your cost of production, and you see, like barley, I'm making money if I get my, 5-year average yield, yeah, that's probably a good sale in the context of so much uncertainty in the world. Like, how much would I maybe do in that context of grains, given what we know? Like, if it were oats or barley or even spring wheat, I'd be a little bit more reluctant to sell, probably because I see some upside for that. But on some of the other grains, I mean, again, 10 or 15% probably isn't wrong, as long as it pencils out in the black right now. I mean, if things are all penciling out in the red, I mean, Houston, we got some problems. We're going to have to like reassess and kind of think about, what we're going to do. Because just remember, the farmer in the United States is probably seeing the same thing, but they have Uncle Sam behind them ready to cut them a great big check. So they're not going to be like, well, these prices aren't good, I'm not going to plant. No, they're going to plant every single acre. So we have a solid wheat export program, sort of a carryover from last year. There just seems to be a steady demand for Canadian wheat, 400,000 tons a week on average for 52 straight weeks. We're seeing the list of customers that we're dealing with is ever expanding. People are coming in for small batches, big batches, multiple cargoes. The basic technique of the people selling wheat on the West Coast is just price it a little bit below US spring wheat. Again, I would think in the US, if they do impose a 25% tariff on Canadian wheat, there'd be a stronger demand for US spring wheat within the US. So it could be a zero-sum game from a Canadian perspective, that we lose some market in the US for spring wheat, but we gain the market that the US isn't exporting the spring wheat that they're going to, keep within the US. So I think wheat overall, like, it's not a good thing, these tariffs, for sure, but I think wheat overall has some resiliency to that, more so than, say, canola, where such a big center of canola demand and the canola byproduct demand is the US and their renewable diesel and renewable fuel policy, which again is in a massive state of flux right now. Nobody knows exactly what's going to happen come January. So again, the Russian export policy is a huge X factor. We've talked about that before. I would say there's a high probability that we'll see some restrictions there. Canadian exports have been relatively strong to start the year. You can see the only concern would be oats. We're not doing great in oats. Again, we don't pick up all the oats in the bulk handling system. Some of them go by trucks, but everybody who's dealing in oats knows that the sort of the oat market is tamped down and a little bit subdued at the moment. But you can see that canola's been great. We'll talk. Ranulph will talk about that a little bit more. The pulses have been fairly solid, and Durham's been quite good. Wheat, I mean, it's not that exciting, but you can see that we are still 12% above the 5-year average. And, I think we're gaining some traction, and there's a lot of wheat that's going into the pipeline, and that, ensures that there'll be more exports over the next little while. So the durum market, it's been okay. I don't think there's going to be any great shock upwards in the durum market. We've done pretty good. We've been fairly aggressive selling. We, in fact, added to sales for durum, so we're up to 80% sold on durum right now. Again, there's some X factors in the durum market. One would be like, what's Turkish behavior going to be for the second half of the year? Are they going to return and become sort of aggressive exporters? We've had a good crop for selling durum because we've had all 5 grades represented, and counterintuitively that actually makes more buyers, because there are Italian buyers, for example, love to buy our 4 and 5 quad. So we've been moving a lot of durum. So again, I think it's something to be favorable. Again, we do export a little bit of durum down to the United States, but I think durum would also be fairly resilient, because what would happen would be they would just buy their own durum, and then some of that durum from the US that gets exported, we'd pick up some market, because there really aren't too many exporters out there, and particularly geographically, some of the countries that the US services, Canada, would have like a freight advantage on the durum front as well. CWRS prices are down from their 2022 peak. Obviously, that was sort of that war premium that largely came out. I think overall, spring wheat in particular has shown some resilience. I mean, I think we have a chance for it to go higher here, because I think the Russians are going to be more or less absent for a period of time from the export market. The question is whether or not demand will be robust enough to kind of drive it back up. And then the other thing too is, if the war looks like it's going to end, I mean, that could also deflate wheat prices a little bit more. Remember, the Canadian dollar has been a huge boost as well. We've got a lower than probably people were anticipating Canadian dollar, like a 71-cent dollar. And I think most sort of analytical groups, including ours, was kind of projecting more like a 74 to 76-cent dollar at this point in time. But I think the reality is it might go lower before it goes higher. For barley, there's nothing too exciting happening. I mean, we could make offshore business because the European Union didn't have a very good quality crop. So there might be, a little bit more people out there buying Canadian malting barley. We really haven't seen much activity offshore for Canadian feed barley. It seems that it's not as affordable to, and trying to make a cargo for the ports, you're competing with the feedlots within Canada, and usually the economics are such that, like, just getting it to the feedlot is at a better price than what somebody would be willing to pay for us via Vancouver for feed barley. So we're not expecting any big jump in that. And as you can see, that like on the back on the barley export chart, like we're doing okay. There was poor quality, and we'll see that. For oats, it's a tired market. It's sort of lost its sexiness and appeal. We've said this before, but there was a lot of consumer uptick in oat demand in the pandemic. If you had traveled to a grocery store in an urban center in the US, you would see like a lot of shelf space dedicated to oat type products. If you go back there now, that shelf space has declined. It's not there. Like oats are not there. And the kind of consumer who was buying those oats is a fickle consumer. They're always on to something else because they saw it on Instagram, or some guru told them that now they should eat something else, or wear something else on their face when they sleep. So, these oat creams and stuff like that, they're just not as in demand as they were. So oats are okay, but I mean, again, I think that, you know, we really lack any sort of incremental spark in oats. One very interesting thing was Brazil and China signed a bunch of deals, and one of the deals they signed was for Brazilian oats to go into China. And Canada has been trying to get market access into China for oats for like 20 years. And, if you ask AAFC what's happening or the government of Canada, it's like, we're working on it, we're working on it. And somehow Brazil got it done in like, 6 months. So if we had access into China, that would probably be a 400,000 or 500,000 ton a year market, because there are a few regions of China where oats are a staple kind of consumption for breakfast. And again, it's not like the entire country doesn't really eat oats, but these regions, and again, in those regions, there's 30, 40, 50 million people. So it could be something, but I'm not holding my breath for that.
All right, fabulous stuff, Neil. Thanks so much. So I'm going to be doing a quick run through the oil seeds with a focus on canola, touch a little bit on soybeans. We may have some soybean growers on the call. Soybeans, of course, a leading global oil seed. The US soybean crop. Well, this chart kind of puts it in perspective. Although there were some minor adjustments in the November WASDE, in the grand scheme of things, the US produced a very large soybean crop in 2024. Here you see it in perspective back to 2000. Of course, big supply, questionable demand, concerns about exports to places like China under the new administration means that ending stocks for soybeans are headed in the wrong direction. They are headed higher, expected to come in at the highest currently since 2019-20, and that is probably understated. In other words, ending stocks could rise more if US exports continue to underperform moving into the 2025 calendar year. The trend, as shown here in terms of days of use, also headed in the wrong direction, higher. That means lower prices. There's an increase in the supply on hand, and that is dragging on prices. It may not tell us what's next for prices, but it explains a lot about why prices are currently under pressure. And of course, on the horizon, in fact, not that far on the horizon, more of a tomorrow story, is South America. Expectations, as with corn, the slide Neil showed you, expectations are running extremely high for both corn and soybeans, which you see here. The USDA elected to kick the can down the road in its November WASDE, making no changes. But make no mistake, this crop you see here is a monster, and it has the potential to swamp the world with soybeans. The ending stocks forecast for soybeans are record-shattering, more than 120 million some tons. It's quite simply enough to really pressure prices. It won't necessarily pressure prices uniformly day after day, but at the grand scheme of things in the macro level, this chart is saying negative things about global oilseeds, particularly soybeans. And if we look at this chart here, what it's showing is that the soybean to corn ratio, the premium of soybeans over corn, is actually suggesting that we're going to see fewer planted acres to soybeans in the US next year in 2025. This is also likely to happen in Canada. Very slowly, this will help to heal the excess supply of soybeans if it proves to be true, but it won't happen overnight. There are still lots of moving parts in the new crop acreage on both sides of the border, and it's going to take time to mop up that South American supply if it comes close to reaching current expectations. For canola, well, we've talked quite a bit about canola already in this webinar, but basically, the Canadian supply wasn't as heavy as we expected before harvest. That's good news if you weren't affected, because it means a bit less supply. Exports have been off to a fantastic start despite the lingering threat of a Chinese anti-dumping investigation at some point in the marketing year. It is not yet clear when or if that will get going. The threat looms, but for now, exports are moving well. Crush is also well above year-ago level, and probably, as we've alluded to several times in this event, the political risk hanging over the canola market is considerable, not only with movements of product into the US, but also this situation with China. So there's a lot of moving parts here. We do expect new crop acreage, 2025 acreage in Canada, to be down at least slightly, but that is also going to be influenced by what happens with prices, not only absolutely, but relative to other crops over the next few months. Similar to the ending stocks matrix that Neil showed you earlier, here's what it looks like for canola. And you can see lurking way off in the corner, the upper left, the red. Now that wasn't on the matrix that Neil showed you earlier. That would actually be a fairly tight supply for canola ending stocks, a low ending stocks figure. But we are some way from that today. We're currently penciling in this green area, a comfortable supply, and that's how things look. We're going to need to see some positive demand news, or at least a continuation of the current brisk demand pace, to get over into that yellow or possibly red ending stocks target. And I do remind you, as Neil said, you'll be getting these slides, so you can stop and you can look at these slides in detail at your own leisure. Canola futures, well, kind of an ugly two-pronged collapse here. We saw the canola market collapse in mid-November, paused for a couple days, and then essentially got hammered right back to the summer lows after the Trump tariff threats. Those were the blanket 25% tariff threats made earlier this week. Is that just a negotiating ploy? I don't know. The canola market seriously is taking it seriously, though, if you see what prices have done. So the key question moving ahead, can the relatively supportive looking supply demand fundamentals for canola reassert themselves? They're certainly going to need to for the canola market to make a comeback from where it is today. GrainFox is optimistic it will happen, but we have yet to see proof in terms of prices turning higher following this rough period we're in now. Flax is an interesting one. Just very quickly, you can look at this slide in detail later. We are projecting more acres for new crop flax, and that's because flax is actually calling for more acres. We've been in sort of a situation where flax supplies have been tightening. There is some prospect of demand on the horizon. The EU has tariffs on Russian flax, which will start to scale up in 2025 and then really take a big jump in 2026. I believe it's January 1st, 2026. So the market is likely to encourage more flax acres in 2025, and there are currently some good pricing opportunities available. GrainFox has already made some sales of flax. We do see the overall outlook as being supportive of prices, and GrainFox is not making any new recommendations for flax just lately or today. So I'm going to turn it back over to Neil. He's going to take a quick look at some pulse and special crops, and then we'll be on to the question and answer.
Yeah, so basically with the the supply and demand balance sheets globally for peas and lentils and pulses have been somewhat supportive over the last few years. There's a critical crop right now in India. India is growing pulses 365 days a year. There's, the crop they're in right now is the rabi crop. Weather conditions are okay. We've seen some decline in the domestic prices for pulses, but they haven't broken entirely. It hasn't become sort of, loose by any stretch of the imagination, and they still have to bring the rabi crop home. The rabi crop critical weather will be sort of in that January, February, March period. And I think if you see reports on the CBC or CTV or whatever about, excessive heat, like, several days of 40 degrees Celsius. That's where sometimes in the past few years, the crops have taken a step backwards. So we're going to be watching that very carefully. But the conditions right now are good. So we don't want to say the crop is made, but we certainly don't want to indicate that the crop is, damaged right now. I think it's still at issue, and it's probably off to an okay start right now where a trend yield potential is there. Australia is wrapping up their lentil harvest. Um, there was some speculation about whether or not a frost has done a lot of damage, and we've watching the storylines there. Again, like with other crops in Australia, the primary area where they're growing the lentils is sort of northern Victoria, a little bit in South Australia. I mean, they produce way more than they consume within Australia. So, if you see that the production is 100,000 tons higher than expected, then there's another 100,000 tons that is going to be sought to be put out to the export market. So we've had a pretty good year for exporting so far. On the bulk side, we're up 15%. We're running 14% ahead of the 5-year average, so 15% above last year. One of the question marks might be, did we had a little disruption in the container traffic there for a while because of another strike action? Did that do some damage, whatever? Because in order to reach our total of exports, we do need to also put some in cans. And the ending stocks are, we're calling them 318,000 tons significantly from last year. So we would like to see some incremental exports. So if you look, that our exports are supposed to be up 30% year on year, we're only up 14%. Again, that's bulk. That's not really counting the cans. So we do have some work to do. So, but the prices have been fairly good. And again, on the lentil side, we're fairly aggressively sold because we do worry about the politics and other things within India. Remember, India doesn't sit there and concern itself when they're making food policy with Canada. But we have poked the bear lately. They came over here and assassinated somebody. They shouldn't do that. That's bad. So I mean, we should object to that. But there could be some political fallout to that. I would think India would be in the same boat as Canada right now, where we're all kind of watching and waiting to see what happens with the US and what kind of macro level tariff environment we're going to live in. But when it comes down to it, India is trying to manage, their own food security plus a corollary, which is sometimes in support of that, but sometimes in opposition to food security, and that's income security. So the Indian policy is usually about speeding up or slowing down their arbitrage class. And right now, when it comes to pulses, they remain sort of trying to slow them down or speed them up, actually, to get pulses into the country by maintaining tariff-free access. Peas, somewhat similar. I mean, I think the good news on peas this year is that it seems like there's more marketplace for yellow peas than just the traditional countries, and we've been exporting those fairly good. Green peas have had great traction. So on the export side, we're actually up 40% from last year. That's early, and we're running 16% ahead of the 5-year average. I mean, we are expecting to export, a little bit like 70,000 tons more. So to be up so much is quite good. And, we did increase our export forecast from last month. And again, India policy will matter on the pea front. But we're also watching China. We're watching other countries. We're watching the competition from Russia to see what they're doing with that. And, we're not really building stocks in any aggressive way. And, we have some question marks about just how many acres will be planted next year. We have it slightly up, about 3% up, but could be a little bit more, could be a little bit less. We have definitely heard from farmers across Western Canada some concern about the agronomics on peas and lentils as well. Finally, chickpeas. I mean, chickpeas have been very tight, but we have our supply this year is the largest in many years. There's still been some strong levels of exports. But we saw a bigger US chickpea production as well. So could be more offshore competition. Exports are slow so far, and ending stocks are set to grow significantly. Now, there was a big demand from India, and they included both the Desi and Kabuli. But what was noted and what is sort of a unique development is that Russia has become a significant supplier there. So Desi chickpea prices have also started to be under pressure from Australian supplies. And again, Australia produces way more chickpeas than they need. So, they're kind of competing. But the Kabulis, the sort of better quality ones, have shown relative price strength. And this is maybe some more Kabulis to be planted in India's season. So our best guess on chickpeas are that prices could stabilize and we might see a modest increase depending on how much of a drawdown in inventories we get due to the export pace. But as we mentioned, the exports so far this year have not been quite as good as maybe anticipated.
Thank you very much, Neil. So I think we're ready to move on to the question and answer portion. Kevin?
Okay, great. Thanks, guys. I think Brandon put it in the group chat. If you have any questions, just use the Q&A button and you can type that question in and we'll get through some of them here today. So if you have any questions, again, just type that into the Q&A button and we'll manage that and get through all the questions that come up. So the first one we're going to tackle is, with oats into China, is BRICS part of the equation?
Yeah, I mean, again, there's two issues here. One is that I don't have any explanation as to why the request from Canada to get phytosanitary approval of oats into China has taken so long. It seems like something that China would benefit from. Now, in the overall context of China, like it's a very small market, oats. But I mean, from a context of Canada, just to have an access to a market that we could export 500,000 tons of oats per year to would make a humongous difference in the oat marketing for Canada. The BRICS, I mean, I definitely think that the deal that China signed with Brazil, I mean, who knows what will actually be implemented, but there's always a pageantry and politics at play there. And basically what China's saying is like, this is our new good friend Brazil, like we're going to suck up their surplus and we're going to do them a favor. But the reality of sort of what gets signed and what happens is quite different, probably in most cases, but definitely Chinese foreign policy of making deals and promising a two-way street often ends up sort of being, they're doing what's good for China. So, I mean, if China wants to buy oats from Brazil, and I don't even know how many oats Brazil produces, I didn't think it's a big crop down there, but I just think like, if it's good for China, it's good for China.
All right, thanks, Neil. Great, great answer. The next question I'm going to tackle here is India tariff on peas is set to come back on in January 25. If that does happen, what does that mean for the pea market?
Well, certainly without tariff-free access, traditionally Canada puts very little of whatever particular pulse or product that they're trying to put into India. The tariff rates are prohibitive. So, we won't be exporting peas to India if that policy happens. But the good thing is that we've shown some resiliency with our pea exports so far, in the sense that like we have some other markets that we're going to. And also the pea balance sheet maybe isn't lengthy enough that if we did lose a little bit of potential exports to India, we could still, there might be some other places that will take it. But rest assured, I mean, from an analytical standpoint and from a farmer standpoint, I mean, we want access to all markets. So, tariffs or other non-tariff trade barriers, these phytosanitary measures, I mean, this is where your checkoffs, this is where your provincial and national organizations, this is where their focus should be on very squarely, is like assuring and telling the Canadian government, we need market access. And Canada relies, and our farm income in Western Canada relies quite heavily on our ability to export product to foreign countries. And my biggest concern going forward for the next several years is that we're going to live in an environment led by the United States, I guess, but where there's going to be a lot of trade hostility. And that, I don't think, is the kind of environment where we can make as concrete plans as we want to make as Canadian farmers, because we do have such a heavy reliance on exporting.
Perfect. Thanks, Neil. There are a couple canola ones. We'll maybe tackle those ones at the end. We'll sort of go through the other crops first. There's a corn question. The corn question is, what window are you targeting for your next corn sale, or what signal are you looking for?
I guess if you just asked me off the top of my head, I'd say probably late December or January is the time to sell corn. November, typically not a month you want to be selling corn. February, the same. Those are traditionally weak periods. November because of harvest. February because of the so-called John Deere slump, resignation, selling, people generating cash to pay bills for the spring. So what are we looking for? Well, corn futures, the nearby contracts are actually in a rally now. They're actually performing quite well. It's the deferred contracts that are really weighed down. So if we get a bit more of a rally on those nearby contracts, we have the benefit already of a 71-ish cent Canadian dollar. So that's working in favor of corn sellers. The only thing I would say, if you start to hear talk in your area of US corn being booked to come in, that would be a signal that you might want to get more aggressive and look to move that corn right away, because at some point there is a risk, even with the low Canadian dollar, that US corn comes in. And when that happens, that would likely be the so-called import ceiling. That would likely cap the strength in the local Canadian market in Western Canada. The final point I would make, if you're in touch with your buyers, whoever they are, feed mill, whatever plant, if they're buying, that's when you want to be selling. That's another factor in your decision matrix, because most people tell me in Western Canada that once that demand disappears in your area, then you're in a bit of a bind. So if your buyers are active, then consider moving sales. Those are just general ideas.
Thanks, Ranulph. Moving crops a little bit. This one might be more for the folks in Saskatchewan as they grow a lot of lentils. The question is, what do you forecast as the change between supply-demand dynamics in red versus green lentils for 2025?
Well, we think in the past year, we saw quite a boost to green lentils, and red lentils were a little bit more subdued. We think we think that, again, we're going to get more and more information about trade policy with India. Like right now, I think lentils have tariff-free access into the middle of next year, or sometime maybe the end of March. So that's favorable for red lentils, but that could change. And if we see that sort of like not extended beyond March, I mean, maybe people will, not increase red lentil acres. The great thing about green lentils, again, it's sort of like green peas, but even more so, is just like there's a multitude of markets for those. And we're not shipping too often, like a 70,000 ton ship somewhere, but I mean, we're steady as you go, and there's a lot of different markets. So I would expect there to be maybe not as big of a change year on year. Like we won't see a huge increase in either of those acreages, and we have a very modest increase in the acres kind of scheduled, I think, or a modest decrease. So I think probably, if I had to guess, I'd say like red lentils will sort of have their traditional base, and the green lentils might come off a little bit just because of some people were sort of lentils a bit, and rotation will dictate going back to something else.
Perfect. Thanks, Neil. This one's around wheat. So with respect to the proposed wheat OPEC, how will Russia benefit with that when India and China like to buy low protein wheat or low priced wheat, pardon me?
So
I
this is
guess I'll-
this is sort of like somebody thinks there's going to be a wheat OPEC.
I think it refers to the recent suggestion by Russia that some of these other countries join forces to try to manage the global wheat market for their benefit and less to the benefit of countries like Canada and the United States. So I
Yeah, I
guess
mean,
my initial thought on that is if you look at the real OPEC for crude oil, it is very hard to get the OPEC members to agree on anything. There's a strong incentive to set quotas and then cheat, and that's what happens. The wheat idea that's been floated is very far, I think, from being functioning. Russia obviously would like to have control of the wheat market. I don't think they're going to succeed in doing that. And I think as much as countries like India and China and Egypt would love to buy cheap wheat, they can already do that. I think the proposal, if I'm understanding the question correctly, mostly refers to controlling the world market for the benefit of certain countries to the exclusion of countries like the United States and Canada. I don't think that will succeed.
yeah, 0% chance that it succeeds. In fact, if they do anything except for travel to exotic locations and have meetings about it, I think it would be probably a net benefit for Canada because they'll screw it up.
Great, thanks, guys. We'll switch over into the canola stuff. So SAF was looking like it was going to create a stable floor for canola. Is there talk that this is in jeopardy now?
I think the honest truth is that nobody really knows. I mean, sustainable aviation fuel, obviously, greenwashing, whatever you want to call it. I mean, there's a sort of a parallel economic reality for it. Like airlines want to, they want to make a certain customer segment feel good about that. Um, you know, uh, there's been some companies that have started to back off from some of their green initiatives because, as the election in the US said, the environment is a pretty low priority in reality for most people. The Democrats didn't even campaign very hard on the environment. And you're seeing signs of that in European Union and other places as well. So, and at the end of the day, I think it's going to be a simple matter of, double entry bookkeeping. Like, is the SAF available in enough quantity at a cheap enough price that it's worthwhile for the companies to do versus the benefit they feel they get in the marketplace? So I would not be counting my chickens until they hatch on that front. And I think if you widen it out into a broader kind of comment about what will the next 4 years or alternative fuels and how beneficial will that be for canola and feedstocks and other things, I would say there's more uncertainty today, November 28th, than there's been probably in the last 3 or 4 years. But over the last 3 or 4 years, I mean, how many times have we been to a presentation by somebody who's been saying something like, oh, biodiesel will be bigger than ethanol? And, we've seen some benefit, I suppose, but certainly we haven't seen the scale or scope of benefit that was maybe promised. And we've been like, oh, just wait, just wait. But I would say that today, you know, I think the waiting is not, we're not going to see a tangible excitement in the 24-25 marketing year, and we're not going to see a tangible excitement in the 25-26 marketing year. And sad to report that we may not see a tangible excitement on the oilseed front in the 26-27 year. The one question I would say is, like, on the periphery, very important in big population centers like Indonesian policy or Malaysian policy or Indian policy or Chinese policy, maybe those are the ones that are going to have to save us from really what looks like a tiredness in the West to kind of follow through and expand and really make this something that is going to be on par or somewhat equivalent to the ethanol era.
Yeah, and just very quickly thing to add, one of the European airlines actually floated the idea of a surcharge for SAF, and needless to say, that went over like a lead balloon. So I agree with what Neil says. I think also the ultimate question is, are consumers willing to pay for SAF? And at this point, there doesn't seem to be that willingness.
Thanks, guys. Appreciate that. That's great insight. This is back sort of to probably more focused on the Saskatchewan crowd. With mustard prices dead in the water, why wouldn't acreage drop more than 500,000 acres?
Well, if you're referencing the work that we presented earlier, which I think this is, that was very preliminary work. It is going to be subject to change, and we respect the fact that mustard is not making any attempt to secure more acres, and it's not, it's sort of willingly ceding acres to other crops, seeding with a C. In other words, giving them up. The question, of course, is what wants the acres, and I think that ultimately it remains to be seen how much mustard acres will drop, but there do need to be other crops that come in and fight for those acres. Do you have any thoughts to add, Neil?
Yeah, I would just really stress that, we're just like, it's very early. There's a lot of uncertainty. And yeah, mustard looks like one of the losers, but because there aren't as many clear-cut winners, it's just kind of saying like, where do people allocate the acres right now? And it's not as obvious as maybe as in the past. And, for example, I think like, when I talk to some other analysts and other people across Western Canada, I got numbers that were, for canola, for example, down 1.5 million acres, as high as like up 1 million. So, we kind of held ours a little bit close to the average or close to where it was, just because I don't see the mood right now for swinging really big into something. And so, yeah, mustard's probably going to be down. We'll revise it, but maybe it could change. I don't know.
As I wrap it up here, you can see on the screen there is the QR code for your CCA CEU credits. So please scan that app or that QR code in the app to get your CEUs. If you don't have the app or it's not working for you, just fill out your certification details in the post-event survey and we will register you. So we get you guys covered there. So with that, I just want to thank everyone for attending today. Appreciate our speakers very much. You guys did a terrific job. What I took away is the world is complex. There's lots of information to digest. You can go on either side of that information. Sometimes the information is put on both sides of the topic, so you have to sort of decipher what is real and what is not. The grain markets are impacted by many factors, and that information a lot of time impacts them, so you sort of have to wade through it. So with that, I know that all the growers on the call today, they run very complex businesses, and hopefully this webinar offers you some insight into your grain marketing this winter and can put some clarity around what's happening in the world. And we've got two of the best again on the call today that gave us that information. So thanks so much for that. We don't do this often enough. On behalf of Syngenta, I just want to thank our customers. You guys really drive our business and pay the bills at the end of the day, and you don't get thanked enough. So thank you very much. Our goal at Syngenta is always to help growers grow their best crop, and then we use the folks at GrainFox to help them market their best crop. So again, thank you to the growers. You guys truly are valued, and we don't get a chance to thank you often enough, in my opinion. So thanks very much. With that, I'm just going to wish everyone a safe and happy holiday season. I hope everybody has a prosperous new year, and I look forward to having record-breaking yields in Canada next year for all growers. I hope everybody has a great season. Thank you for attending the webinar. There will be a post-webinar survey starting as soon as we click out of here. So thanks again, and look in your inbox in a few days for the cleaned up version of the webinar. So if you missed anything or want to review any information, you will have access to it. So thank you again. I wish everybody well, and we'll talk to you soon. Take care. Bye now.